You know, we've doubled our debt between 2004 and 2014. We've doubled it again between 2014 and 2024. We're now at $36 trillion in debt. I looked at the debt clock this morning, number one. Number two, our interest on our debt is $993 billion. It'll be $1 trillion in another week for the first time ever. And this puts us right on the edge of a doom loop. And
welcome back to Metals and Miners. I'm its founder and its host, Gary Boehm. Today we have a fantastic discussion lined up. We're fortunate to have with us DANA Samuelson. DANA is the founder and CEO of American Gold Exchange since 1980. Prior to founding AGE, he worked for some of the most influential precious metals trading companies in the nation and was a personal protege of James Blanchard III, one of the true giants of the industry and the individual who's most responsible for re-legalizing the private ownership of gold in the U.S. He's a regular speaker at industry conferences. DANA, thank you so much for joining us today.
Hi, Gary. It's great to be here with you. Thanks for having me.
So let's begin with what your analysis is of the current economy and markets. What kind of economy is President-elect Trump inheriting, and what impact on it are his policies likely to have, and where do you see the opportunities and risks being?
Wow, well, that's a loaded question. So according to government statistics, Donald Trump's inheriting a pretty decent economy. We had 3% GDP in the second quarter, 2.8% GDP in the third quarter. Inflation's been coming down, but we've been talking about it being sticky. It appears now that it may actually be stuck and could perhaps rebound a bit. The employment market is doing fairly well, although we're seeing increasing layoffs, new jobless claims, unemployment claims are steady. Inflation's not quite in check. I think he's inheriting a pretty stable economy that may be on a bit of a decline. So policies, he's going to cut taxes. So we're seeing a boost in equities markets. We've seen a spike in the dollar. We've seen a rise in treasury yields. We've seen gold and silver pressured lower due to their inverse correlation. We got deregulation, which should be good for the economy as well. Less government getting in the way. Tariffs are potentially inflationary, although they are a negotiating tool. So they're kind of the stick before the carrot, I think. So hopefully you won't impose them to too great a degree or won't be forced to, because I think that they'll have a deleterious effect on the economy overall. So we'll have to see. He is a disruptor, and he's going to bring a lot of change. One of the concerns that I do have is that if he's, government's 40% of our employment these days, 40%. And if he makes some significant government salary cuts across all segments of the government, which he could, that by itself could have a negative drag on the economy. So time will tell. Time will tell.
Yeah. So I don't want to put words in your mouth. So do you see this as being late cycle, 1999, early cycle, 1995? Do you think we're moving into a new roaring 20s like the 1920s? What do you see here?
Oh, I think that the equities markets are the roaring 20s right now. They're running pretty hot. The economy is running okay. The lower part of the economy is not doing well at all. So it's a mix of all things right now. I wouldn't particularly attribute it to any one segment, although the equities markets are pretty strong right now. They've been strong, and they are banking on further Fed cuts, which may not be quite as aggressive as we have been led to believe. The inflation print just came out 2 days ago, and as I said, inflation seems to be stuck, and Powell tried to walk back, their aggressive rate cut cycle forecast just yesterday, and stocks are getting hit today on that. So we'll have to see. But that's been one of the big things behind the equities markets are lower interest rates. And the Trump bump may be peaking about now. We may get a little bit more goose out of it, but I think the majority of the knee-jerk market moves that are going to come from the anticipation of the Trump presidency have already occurred. Now we have to see how the rubber meets the road, and that's when he actually takes office and the policies that he institutes are enabled. That's a couple of months from now, of course.
So, Dana, the overwhelming majority of stock market participants and economic and financial experts believe the Fed's basically achieved a soft landing. It sounded like you just echoed that. Are they missing something? Do you believe that they have achieved a soft landing, or is there pain still to come on a lag?
I think the plane might still be in the air a little bit on that one. I'm not quite sure how the landing's going to come. Right now, they're eyeing a soft landing is how I would put it. I still am worried that we might see greater layoffs in the future, which would undermine the employment situation, which would undermine the economy. So, we're seeing the global economy is weak. Germany's got some real problems. China's got problems, of course. And we're seeing more layoffs in the U.S., and they're cumulatively starting to add up. One of the major car companies today, I think it was GM or Ford, announced 1,000 layoffs today out of their tech area. And Trump's going to push a little bit of that repositioning amongst businesses as well, depending on his policies. So I'm not sure we've got quite through the landing yet, and it might be a bit bumpier than we've seen. Time will tell, of course. So
in the past few weeks, we've had two of the biggest titans in the history of Wall Street, Stan Druckenmiller and Paul Tudor Jones. They've openly been discussing the inevitability of a debt crisis here in the U.S. But not only that, they've also been discussing the possibility beyond that they've been betting vast amounts of their own personal wealth on that problem happening by shorting the U.S. Treasury bonds and buying gold. President-elect Trump, Elon Musk, Vivek Ramaswamy, they've all launched the Department of Government Efficiency, and they've stated that they believe that they can cut as much as $2 trillion from the budget. However, the overwhelming majority of government expenses, they're fixed, and they contain annual escalators in them, such as Social Security, Medicare, Medicaid, defense. And then you have the debt servicing, which can be brought lower, but it requires lower interest rates to do that. Dana, are we in a debt doom loop right now that no administration could get us out of? And if they were successful in cutting as much as $2 trillion out of the $6.5 to $7 trillion budget, can they do that without inflicting a lot of short-term pain on the economy?
Well, let's look at the debt doom loop. Number one, if you had a green light was no, a yellow light was caution, and a red light was yes, I would say we're in the yellow zone right now. We are increasing our debt at such a rate, and we have been for so long without remediation on the problems that we have, that we're headed for a doom loop if we're not already in the beginning of one. It's still salvageable, I think, but it's going to take some drastic action. And the cure may be worse than the disease in the short run, as you just mentioned, because cutting a lot of government, cutting a lot of overhead, cutting government spending, cutting government jobs, it's all necessary. We've got to cut our expenses. We're not going to necessarily grow our way out of the problems that we have, a $2 trillion a year deficit, 7% of GDP. So we do have to cut spending, but it's the entitlement programs that are really the biggest of the issues. So it's not an insurmountable problem, but it's becoming one. We've doubled our debt between 2004 and 2014. We've doubled it again between 2014 and 2024. We're now at $36 trillion in debt. I looked at the debt clock this morning, number one. Number two, our interest on our debt is $993 billion. It'll be $1 trillion in another week for the first time ever. And this puts us right on the edge of a doom loop. And we've been talking about the debt for years. It's only in the last 12 to 18 months that I've seen more and more debt problem related stories in the media percolate up. So it's finally being discussed. Whether it's too late or not, it may be, but you can kick that can down the road a while longer before it actually bites you. So it's the servicing of the debt that matters more than anything else in the great scheme of things.
Do you view the Fed as being in a box here? If they lower the rates too far, they ignite, an inflationary crisis all over again. They incite a stock market melt up. If they tighten up too much, then we have significant problems in the economy. Do you view them as being in a box here?
Well, I think if they stimulate too much, we go back into an inflationary cycle, a ramping up cycle. I think that's a given. Now, we've had really high rates considering, and they've brought them down, and that didn't create so much damage. So I still think that we could be higher for longer without a ton of pain. But overall, over a period of time, that will really start to matter.
That would contrast with the $2 trillion in cuts that they want. If the higher the rates, the higher the debt servicing, the harder it is to cut the budget.
Yes and no. We're going to have an interest payment that's higher with higher rates, but I don't know how much greater that would be than some of the cuts they might make could be. So we might get a net positive out of cuts that may be offset to a degree, but not fully, by higher rates.
So, Dana, why do you believe that the 10-year yield has been rising since the Fed cut rates, 6, 8, 10 weeks ago? Is it deficits, stronger growth versus, with Trump coming in, inflation, higher government spending, lack of debt buyers? And what are the implications of the rising 10-year?
Well, it means that investors that want to buy U.S. bonds are demanding a higher return for the risk that they're taking fundamentally. And if you look at some of the other, I'm not going to count myself in the same league as someone like Luke Groman, but I believe Luke has said that 3 of the largest treasury buyers, number 1 is China, number 2 is Japan, 3 is Luxembourg, 4 Great Britain, 5 is Cayman Islands. They represent hedge funds. I may have them a little bit upside down, but they represent tax-free zones, and they represent more trading entities than governments that would buy our treasuries and hold them and not care for the long term, or pension funds that have to have something for the long term. If our debt is shorter in duration, which it is, and Janet Yellen has pushed the duration into the shorter term treasuries, and these are people buying them that are more traders than holders, they're likely to dump them too, which would push the yield up, right? So, we're in a bit of a box with our treasury market, I think. Now, how it resolves, I don't know. That's not my area of expertise. But it's interesting to see that we're selling more short-term treasuries than long-term treasuries, and a lot of the holders of them are more trading types than they are fundamental buyers and hold players that we've had for 40 or 50 years going into this last couple of years.
So there was an especially strong post-election stock market bounce in November 1980, but the celebration of Ronald Reagan's victory, it didn't last very long, and stocks fell into a long, grinding bear market during all of 1981 and part of 1982. Similarly, there's been a strong bounce since Trump's election. Now, of course, we have a long way to go until Inauguration Day in January of 2025, but does the market face the same risks today that it did in 1981, do you think?
No, we're in a completely different world today. 1980, 81, we were coming off of interest rates at 18%. Inflation hit 18%, and interest rates were 15% or higher. The economy was not in good shape. This is a different world today. What we have today is a lot more debt, but we have lower interest rates and a much more stable world, although we do have 2 wars going on. One, I think, is actually going to get settled pretty quickly here. So I don't think you can compare those as apples to apples in the current world that we're in right now.
Do you believe that the market faces any risks at this point?
Oh, yeah, absolutely. Absolutely. I'm not a stock market expert per se. There's a couple things that bother me. It's the growth of passive investing rather than active investing. And a lot of the money that goes in the stock market goes in automatically through ETFs and all kinds of funds. And it's created if you follow Michael Green et al., it's created a herd mentality. and the herd likes to just follow the rise up. So what's this creates in the process is a market that doesn't self-correct well along the way. So when the steam needs to come out, it can stay in the market. And then when it breaks, it could break really hard because it's more of a herd changing direction. Now, if we see that, we could get a vicious correction in stocks.
The reason why I brought up the markets, though, Dana, is because in the 1970s gold bull market and the 2000 gold bull market, there was a correlation with the stock market dropping in both instances.
Well, there's times right now when we see the stock market go up and gold rises at the same time. So the correlation, true, I think, is different. The 70s were similar in a way to what we're going through now with gold, in that we had a run up and then a correction and then a second wave started. And I think that this bull market in gold could actually be looked at as a 30-year bull market that actually started in 2001. And it's elongated compared to the 10-year market that we had in the 70s. And the reason I say that was the bull market in gold in the 70s started because the U.S. went off the gold to dollar peg, and we became a fiat currency for the first time ever, and we started to create more debt. We had oil shocks, we had geopolitical crises, and a couple of waves of inflation. Now, what's happened since 2000 is the whole world is now fiat money. The whole world has created global debt. Mm-hmm. So you can line the charts up for gold from 1969, 1970 with 2000. And if you stretch out that 10-year period of the 70s to a longer phase, we're about 1977 right now. It's 1978. And 1979 was the biggest year for gold in the 70s.
I'd love to see that correlation if you want to send me that chart. So, Dana, there's now multiple rising inflation metrics. You were just mentioning a little while ago about inflation being sticky, with some signs of a weakening labor market, as you said, and one that wasn't as strong as we were being told. This was evidenced just a few months ago when they revised job numbers down by more than 800,000.
Yeah.
And that came on the heels of, I don't even know what, 13 out of 17 months revised down or some crazy number like that.
Right.
For the first time since September 2022, both CPI and PPI inflation, they're officially back on the rise. In your analysis, did the era of stagflation just begin?
Perhaps. The jobs revision, that massive jobs revision, was done because when the BLS does their surveys on a monthly basis, they get a representative sample of about 10% of the business owners in the country on a monthly basis. That's why it's lumpy, and that's why it gets revised. This annual revision that they did was based on the actual state employment and unemployment claims. So that's our unemployment claims. So that's hard data that takes a while for them to get. But that whopping 818,000 revision was just, that was an eye popper. And I follow the BLS statistics every month. We make our own monthly bar chart graph going back so we can see our own data directly from their site. I haven't seen those revisions in the monthly BLS data yet. I'm not sure how they're going to put them in there. So we're still looking at data that they give us on a monthly basis that doesn't include those revisions.
Interesting. So what's your viewpoint on inflation? Do you see inflation being sticky, ticking back up? Do you see a correlation to the 70s? There's a lot of people that believe that we're in a multi-inflationary uptrend, three peaks like the 70s. Stanley Druckenmiller said once it gets over 5%, it's virtually impossible to root it out of the system. We're at 125 to 130%, debt to GDP, and many are saying we're going to have to inflate the debt away. What's your viewpoint here on inflation?
I think inflation could be a future problem again. I think we could get a second wave that's significant. I think it's possible, especially if the Fed is forced to stimulate. That could create a whole second wave of inflation. Lower rates could add to that. They're really they are in a box because it is a tightrope. That's why I think that a hard landing still is possible. Although it looks like we've got a softer one. I do think inflation is a tricky thing right now. What happens if we have tariffs, right? If the Trump administration imposes tariffs across the board, that means we're all going to pay higher prices. The government gets that money and we get the higher price that we pay. That's inflationary. And fundamentally, we've created so much wealth relative to the population over the last 30 years that the dilution of the buying power of the dollar is just going to continue to erode, which fundamentally is inflation as well, with higher prices. So I think that it's possible that we've got a second wave coming, and this could be the start of it.
So, we constantly are seeing purchasing power loss. They want to stay around 2% a year. Over the last 4 or 5 years, we've had a lot more than 8 to 10% purchasing power loss. But why do you suppose that they won't allow inflation to go negative into deflation for a period of time to bring back parity to that purchasing power loss that we've experienced? Instead, they just seem to be okay with us having this aggregate purchasing power loss. We'll just move on from here.
Well, it's a function of the debt. Paying back today's debt with cheaper dollars in the future is the game. And deflation reverses that and makes everything worse. So that is a lot worse when you have a lot of debt. Deflation is a lot worse problem repaying the debt than inflation is. So that's why the government's pushing for modest controlled inflation. Now, it's possible we could go through a deflationary period, but I don't see that happening unless the U.S. economy really goes into a real recession and businesses across the board slash and they're forced to really drop prices. We're all paying the price for inflation. They say the inflation rate's 3.2% now, but how much has it been in aggregate for the last 3 years? 22%, 23%? I mean, I like to measure this because I'm from Texas with a steak. A good steak used to cost me $20. Now it costs me 33. Now I might get back to 29 or maybe 28, but it's not going back to 20. That's not going to happen. And that's what I was paying in 2020, 2021 for a nice, ribeye or a strip.
Yeah. So it sounds to me like inflation is baked in the cake, and it's the direction we're headed. So when it comes to gold, what do you think matters more, deficits or presidents?
Oh, I think it's deficits. Presidents come and go. I think the problem with, I've seen gold go up and down across multiple presidents. I remember when Bill Clinton was president and gold was $300. They said the price was manipulated, and then we manipulated it all the way up to $1,900 over 3 more presidents. So I think right now it's our economics more than anything else, and it's because the world is buying gold at record rates, primarily central banks. And that's because they don't trust the U.S. because we've sanctioned Russia, number one. And number two, they don't trust the way we're managing our finances. So I think the deficits matter more than presidents do at this point in time. Now, presidents will have some effect on the gold price, but they come and go.
Yeah.
The deficits have been here to stay for what? I mean, out of the last 40 years, we had 1 or 2 years where we had a net surplus.
Yeah, and so that kind of just comes back to the question I asked a little while ago. If you think they could actually achieve cutting $2 trillion out of the budget, that would imply balancing the budget, but also that would imply that we're only running a $2 trillion deficit, which is what they're reporting. But I think the run rate is closer to 3 to 4 trillion. So I don't know. I mean, it seems like deficits are going to continue to go up. We'll have to see. I'm rooting for cost reduction because cost reduction is good and cost reduction is my background, but as Lynn Alden likes to say, nothing stops this train. It just seems like everything's baked in the cake. But Dana, you mentioned the U.S. dollar earlier being strong. So it's climbed in something like 22 of the last 33 or so trading sessions. It's soaring 6.5% up in that time. The dollar's ascent has halted gold's rise, and it's sent it backwards a bit. Is the dollar now overbought and at risk to a pullback sometime soon, and gold oversold and its risks are to the upside? In other words, is gold now in a range from which it will become highly sensitive to any weakness in the U.S. dollar in a positive way?
Oh, absolutely. They're completely inversely correlated right now. And we have seen the Trump bump spike the dollar on the US dollar index from about 104 to almost 107 in just a couple of weeks, which is very strong. And conversely, gold's been pushed down from 27.50 down to 25.50. We saw the exact same thing happen when Donald Trump was elected in 2016. We saw the dollar surge 6% between Election Day and January 1st. And then we saw the dollar lose 5% between January 1st and about March 1st. And the same time, gold dropped 11% and then rebounded 10% over that same 4-month period. Last 2 months of the year, first 2 months of the year. This time, I think we've gotten most of that same kind of a move in the first 2 weeks of the presidential election because things happen faster, right? So I do think most of this Trump bump, the knee-jerk reaction to the Trump trade, as I'm calling it, has occurred. Now, that doesn't mean it's not over. It could go on a little further, but I'm starting to see exhaustion at both the top of the chart for the dollar and the bottom of the chart for gold on a daily candlestick basis. Stocks are selling off a little bit today. Bitcoin's down a little bit today because of what Powell said yesterday regarding inflation. And maybe we won't get that 1/4 point rate cut in December. Maybe they'll slow down the rate reduction over time. So I think we're nearing the end of this move, but it may not quite be over yet.
So staying on that topic, though, about the 2016 election, what happened then with the dollar, what happened with gold. After that drop and return, what followed after that was 2 years of gold prosperity. In your opinion, does history repeat itself here?
Well, there's a lot of fundamentals that are driving gold that are still in place, right? So it's debt, it's our interest rates. The dollar's value against other currencies is the shortest term influence on the metals that you have, and it's directly inverse. And that's just a kind of a knee jerk right now. You've got central bank gold buying, which is one of the biggest factors. They're going to buy almost 900 tons, maybe a little bit more than 900 tons this year.
If you're believing China, they're not buying any.
Well, they are. But, I follow the World Gold Council statistics because they're the most reliable that we get. And central banks, on average, since the great financial crisis between 2011 and 2021, bought 500 tons of gold cumulatively annually. They doubled that in 22 and 23 because of the Russian sanctions and their fear of being sanctioned by the U.S. globally. So central bank buying has gone way up. It's just going to be a little bit less. So that's a big, big underpinning for gold, right? Number one. What if we go through more geopolitical instability? I do think the Ukrainian-Russian conflict is going to get settled. Russia will get to keep what they already have. The Ukraine will stop getting attacked, and they'll have their sovereignty for a while longer. Maybe not forever, but for a while. And that'll take a little steam out. The conflict that bothers me that helps to buoy gold is Iran versus Israel. And Bibi Netanyahu's done everything he can do to eliminate Israel's enemies. He's decapitated Hamas. He's decimated the Hezbollah leadership. They've taken a couple measured strikes on Iran, and they've been tethered by the U.S. government under the Biden administration. Now, Trump is no fan of Iran, and he is a fan of Israel. And I believe he's already told Bibi Netanyahu, do what you have to do. So I'm a little concerned that conflict could get worse before it gets better. And that's the one that worries me the most. So that's going to help to underpin gold. And then you've got the financial situation, the debt. It's just going to keep going higher and higher. So, yeah, we've got an inversion right now, but I don't think it lasts. I think it fades out as time passes, and gold is still on a train to $3,000, $3,500 an ounce in the next couple of years.
Yeah. And, as I was listening to you talk about all these different factors and the central bank buying, I have read that the European countries have a 4% of GDP mandate to own gold in terms of 4% equal to their GDP. And they're not all there. So they're also buying, their central banks are also buying. back. It's free. Go to metalsandminers.substack.com. We post free content on the consumer economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. They are all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, If You Don't Own Gold, You Know Neither History Nor Economics. This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us. Also, I'm positive that you've enjoyed the conversation with Dana as much as I have. Please let him know. Hit the like and subscribe button and leave a comment below the video.